All eyes are on those FOMC minutes that are going to be released later this afternoon, and investors are waiting to see if they'll actually hear anything new from the Fed. Joining me today is Joe Greco from Meridian. So Joe, the last Fed meeting, there was a lot of volatility in the markets because they were hinting that they could begin to scale back on their QE program. Do you think we'll actually see anything new in these meeting minutes?
Well, not much has changed since the last time when Bernanke in particular and the minutes spoke about the rough framework of varying the asset purchase program. But I do think what he will comment on most likely, because he speaks after the actual minutes are released, I think we'll see some commentary on what needs to be done and what is going on in the economy right now. Of course, yesterday we had the IMF downgrading growth expectations. We've had a couple of variations on what the expected growth is for the second half of this year and just how quickly the tapering, quote, will begin.
And also moving on to globally, looking at China, their export data really disappointed today. Do you think this will hint at them maybe trying to pump stimulus into their program now?
Well, I got to think that China is going to do everything they can, as they generally have, and as most central banks or governments should do, to keep, of course, the trade imbalances in their favor. Exports from China, falling is a little bit of a worry for them. Of course, consumption globally of goods and products, especially out of China, is just not meeting the demand expectation. So I would anticipate that we're going to see something out of there very soon.
And finally, we did see wholesale inventories data for the U.S. today that fell in May for the second straight month. Do you think this will somehow kind of put a damper on second quarter growth if businesses aren't restocking as much?
Well, remember, the general theme has been, do more with less, right? And that includes what's on the shelves. So try to, increase revenues by decreasing what's kept on the shelves, because you don't want things to, one, get stale, cost of goods sold, and then, of course, when inflation takes hold. So at this point, I think really to keep that number lower is still good. But what I would like to see is consumption increase, consumer spending increase, and then those inventories increase, because if it's all in lockstep and you get the turbo boost of the unemployment rate dropping precipitously, then you're going to really see some nice upticks for top line revenue growth.